Okay, today I'm going to discuss about past paper accounting, paper 1, paper 11, October-November 2017. Okay, let's start from number 1. Which statement describes a purpose of accounting? To check the arithmetical accuracy of double entry, to ensure that all transactions are recorded, to know the balances on individual customers and suppliers account, or to provide a calculations of profit. The best answer for this question is D. Okay. Okay, why? Because first of all, this and these two are the purpose of trial balance. Meanwhile, to know the balances on the individual customers and suppliers account, that is the purpose of purchase ledger and sales ledger. So, since all of these three are not fit for the definitions of or descriptions of accounting, so the best answer is to provide the calculations of profit. Because purpose of accounting is to give information, right? To give information to users so that it can help them to make business decision. Yeah. One of them is profit. If accounting gave calculations of profit, it will lead to business decisions at the end. So the best answer is D. Number B. A credit customer buys goods with a list price of $1,000. Trade discount is 30% and cash discount is 10%. Now, if a question gave you this word, list price, that means this is the price before trade discount. And if it's a cost price, that means that's after discount. Okay? If it's a cost price, it means price after trade discount. So, next, which amount is entered in the customer's account to record the sale? It said entered in the customer's account. That means this transactions is not a cash transactions. This is a credit transactions, a postponed transactions. Because if it is not postponed, there is no customer's account. Because that transactions goes directly to cash and there is no customer's account involved. Since it said entered in the customer's account, that means it's a credit transactions. And there is no payment made yet. That's the clue. There is no payment made yet. So that means this cash discount must be ignored. Yeah. So which amount is entered in customer's account to record the sales? 1,000 minus 30% of the discount. 30% of 1,000. So minus 300 equals to 700, and the answer is C. Okay, just pay attention on that. Yeah. If it said customer's account, that means there's no payment made yet. No payment. So cash discount is ignored. Cash discount is calculated whenever there is a payment. If there's no payment, it's ignored. Okay? Continue. C. Where is discount allowed recorded? Discount allowed. The business allowing discount to customers. Yeah. Which means, where is it? It's on the credit side of the sales ledger control account. Sales ledger control account is as same as trade receivable. Whenever there is discount allowed, that means you are allowing discount to your customers, which makes your customers account decrease. Your customers account is trade receivables. Trade receivables is asset, and asset decrease in the credit side. So on the credit side of sales ledger control account. Yeah. Next, N's statement of financial position includes the following: an amount paid by N for a service which has not yet been recorded. An amount paid by N for a service which has not yet been received. An amount received by N for a service which N has not yet provided. The value of a service received by N for which payment has not yet been made. Which items are included in other payables? Other payables means not trade payables. Yeah, this is not trade payables, but this is an accrued expense or prepaid revenue. Okay. Or prepaid revenue. Well, from number 1, an amount paid by N. We are from N's point of view. Okay. Amount paid by N. Amount paid by N for a service which has not yet been received. So you paid for something that has not yet been received. That means you have spent a money, but you haven't got the benefit out of it. So it will consider not a liability to you. Other payables is a liability to you. Okay? Since N have paid it, but she did not receive any benefit out of it, so we will consider that as an asset. So any answer with number 1 will be eliminated. Next, if you can see C and D, both of them has number 3. So the best way to know is to see number 3 first. Yeah, to shorten our time, to save our time, to save our time. The value of a service received by N for which payment has not yet been made. A value of service received by N. So N received amount of money already, but the payment has not yet been made. The value of a service received by N. So N received an income. Yeah, she received an income, a service. She received a service, but then N has not yet paid it. She has not yet paid it. So it will consider as liability, of course. Yeah. Now, Number 2. That means either numbers C or D. Okay. For number 2, an amount received by N for a service which N has not yet provided. An amount received by N for a service which N has not yet provided. This is considered as prepaid revenue because N already received a money, but then N has a liability to give the service to her customer. That means she has a prepaid revenue. Prepaid revenue is considered as liability, yeah, and has a debt in a form of service. So number 2 is considered as other payables, as well as number 3 is considered as other payable. Yeah. For number 3, if service received by N and payment has not yet been made, is a liability or also called as accrued expense. So the answer is C. Next, E. Hero wishes to increase his provision for doubtful debts at the end of the year. Wishes to increase his provision for doubtful debts at the end of the year. How does he record this increase? Since provision for doubtful debts is considered as an estimation of loss, that means it will be treated as an expense. Yeah, so whenever this provision is increased, expense will increase. Okay, and then provision also at the same time will increase, yeah, by the same amount. All provision has a normal balance in the credit side. Any provisions, yeah, provisions for depreciation, provisions for doubtful debts, any provisions has a normal balance in the credit side. So if it is increased, that means provision also increase. Provision increase in the credit side, so we can eliminate answer B and answer D. Yeah, leave that. Now the next, either it's A or C. Increase in doubtful debts, it is not a bad debt because it is still a doubtful debt. You don't know whether they will going to pay you or not. What I mean by they is customers. What I mean by they are customers, yeah? Next, since bad debts is not a doubtful debts, so you can eliminate A. The right answer for increase in provision for doubtful debts is income statement in the debit side and provision for doubtful debts in the credit side. Yeah, because it is an expense and expense is in debit side, and in the income statement it also shown in the debit side. That is why here income statement in the debit entry. Yeah. F. Tang bought goods costing $20 each. At the end of the year, Tang valued inventory of unsold goods at the selling price of $30 each. What is the effect of this valuation? Okay. F. Tang bought goods costing $20 each. At the end of the year, Tang valued inventory of unsold goods at the selling price of $30 each. Unsold goods, if we talk about unsold goods, it means that we are talking about closing inventory. Now, in the answer, you have profit and then purchases. When it comes to inventory and there is something that is overstating, yeah, In this case, your inventory, business inventory, has been overstated because first of all, the inventory has a cost of $20, but then it is now valued at selling price, which is $30. Now, if you can see here, it's called overstated. Yeah. So the business accidentally or not accidentally overstating the inventory. Now, if we are talking about unsold goods, it means specifically we are talking about closing inventory. Now, closing inventory has a parallel effect to profit. Parallel effect to profit. So, if your closing inventory increase, your profit also increase. If closing inventory decrease, your profit also decrease. Yeah. Meanwhile, purchases. Purchases has nothing to do with closing inventory. Okay, so we can eliminate purchases. Yeah. If we are talking about inventory, we are talking about prudence principle. If you remember prudence principle, yeah. Prudence is not to overstate, not to overstate asset and profit. Yeah. So closing inventory has a parallel effect to the profit. Now, if your closing inventory has been overstated by 30, remember this rule, closing inventory has a parallel effect to profit. If closing inventory overstated, that means profit also overstated. Yeah. So effect of this valuation is profit is overstated. So the answer is A. Now you have to be careful with the questions over here. Sometimes the questions ask you what is the effect of correcting these errors or this valuation. Yeah. If the questions is like that, that means you have to make correction, and that corrections which will make the profit to be decrease or increase. Now, based on that questions, your answer must be profit is decreased. Yeah. So you have to be careful on the questions. What does it want? Next. The directors of a limited company increased the general reserve. Which item decreased? When limited company wants to increase general reserve, this general reserve is taken from profit. Taken from profit, and the profit itself goes to retained earnings. So general reserve is taken from retained earnings. It will always be like that. So which item will decrease? It's a retained earnings. The answer is D. Next. Age. A trader provided the following information at the end of the first year of trading: revenue, profit for the year, expenses, and closing inventory. What were the purchases for the year? How to find purchases for the year? If you are given with revenue and then profit and then expenses and then closing inventory, yeah, and it said this is the first year of trading, this word it's not for accessory. Yeah, if there is a first year of trading, that means there is no balance BD, no balance BD, which lead to no opening inventory. So don't be confused because you only given with closing inventory. Yeah. because it's your first year of trading. No opening inventory. How to find purchases? Do you remember trading accounts? Income statement, yeah? First of all, it is revenue. Revenue will goes at the very beginning, and then cost of sales. Inside cost of sales, there's opening inventory, but there's no opening inventory, and then followed with purchases. After purchases, and then followed with closing inventory. Yeah, you are required to find purchases, but you are given with closing inventory, which is 800. Your revenue is 5,000. Yeah, and then cost of sales. Yeah, then gross profit. After you have gross profit, and then minus with expenses, your expenses is 1,400. Yeah, and then you have a profit. Your profit is 500. So you goes up all the way. Yeah, first is this. If your profit 500, your expenses is 1,400, how much your gross profit? Yes, it is 1,900. Yeah, then goes up. If your revenue is 5,000 and your gross profit is 1,900, how much your cost of sales? It's 3,100. Right? Next, if your cost of sales is 3,100 and your closing inventory is 800, how much your purchases? It's 3,900. Yeah, comes from 3,100 plus with 800, so 3,900. So your answer is B. This is your answer. I. A trader had a percentage of gross profit to revenue or gross profit margin of 30%. His purchases for the year were 3,400 and his inventory increased by 400. What was his revenue for the year to the nearest dollar? Yeah. Okay. Gross profit margin. The formula is gross profit over revenue or sales, yeah, times 100%. Yeah. First of all, when you have this percentage, you have to convert it into fractions. If you convert it into fractions, it will become 30 over 100, or as same as 3 over 10. Yeah. So this is your gross profit and this is your revenue. Okay. Next, you don't have any gross profit information yet, but you have a purchases and also an inventory increase, which means the delta, the difference between opening and closing inventory. Inventory increased by 400, it means opening inventory is lower than closing inventory by 400. So if I assume opening inventory is 0, closing inventory is 400. Yeah, this is what it means. Okay, now what is this for? This will use to calculate your cost of sales, because in cost of sales, yep, cost of sales is opening inventory plus purchases minus closing inventory, and this and that will be the difference in the inventory. Yeah, just like this. If opening and closing, opening is 0, I assume, and closing inventory is 400, so opening minus closing is negative 400. Yeah, so you have an amount of purchases which is 3,400, and then your difference in inventory is negative 400. Yeah, I will combine between opening and closing, yeah, because we don't have a detailed informations about opening how much and then closing inventory by how much. We just know that they have a difference of 400, so we use that. Opening minus closing, negative 400. So you have a cost of sales of 3,000. If you have cost of sales but your ratio that you have is gross profit margin, which means gross profit and revenue, you don't have any information on cost of sales. So what you do now is to convert to markup, because markup is gross profit over cost of sales. Yeah, and remember, from margin to markup you have to reduce. How to reduce? First of all, 3, gross profit is 3, and then revenue is 10 minus 3, so it is 3/7. So gross profit over cost of sales is 3/7. Okay, now you are required to find revenue, right? Yeah. So to find gross profit, 3/7 times 3,000. Okay, three over 7 times 3,000. Now that's your gross profit. After you have the gross profit, how to find revenue is gross profit plus with cost of sales. Yeah, your gross profit now is, if you calculate 3/7 times 3,000 is 1,286. I round it up, yeah, 1,286. So gross profit 1,286 plus with cost of sales is 3,000. So the answer is 4,286. It's a B. Okay. J. When is financial information considered to be relevant? The answer is when it affects business decision. If it is not relevant, it will not going to affect. If not relevant, yeah, no, forget it. Now, relevant is in accounting policy chapter. Accounting policy. Okay, and inside accounting policy, other than relevant, we have consistency. Oh, sorry, comparability. We have comparability. We have reliability, and then understandability. And this one is reliability. Reliability. This one goes for understandability. And this one is for comparability. Yeah.